In this video, we're going to be going over some sample problems similar to your homework problems for chapter 13. This chapter can be a bit tricky with the math, so I thought I would pull a few problems that are very similar to your homework problems and kind of show you how to work through some of them. So the first one we're going to do is what you see up here on the screen, which is your dividends per share, and how to calculate your dividends per share. So the first thing I wanted to direct you to is over here. When it comes to dividends, if you have preferred stock and common stock, when you distribute them, you're always going to go to your preferred stock first. And then if you have any remaining dividends, then you're going to go to your common stock. So how do you determine if you have remaining dividends? Well, the first thing you got to do is determine how much in preferred stock you owe. And that is down here. So if we look down here, we see we have 30,000 shares of preferred dividends. All right, so it tells us that we have that is a preferred 1% stock at a $50 par. So you take the 30,000 shares that you have, multiply it by the 1%, and then by the $50 par, and that tells you that you owe 15,000 per year in preferred dividends. So that's the number you're going to start out with. All right. And then, so if you look here in year one, it told us that they distributed 22,500 in dividends. So based on our equation here, 30,000 times 1% times 50, we know 15,000 of it's going to go to the preferred stock immediately because they get first, hence the word preferred. So then we do the remaining to common stock. So 22,000 minus 15 means we have a remaining of 7,500 shares that we're now going to distribute in common dividends. So that's year one. Next, we're going to determine how much of the distributed dividends went to preferred and common for the second year. So it tells us in the problem that in year two, they only distributed 7,500. So they only distributed 7,500. So all 7,500 went to preferred because every year they owe 15,000 in preferred stock based on this calculation right here. So since we only distributed 7,500, then all 7,500 went to preferred, but that's not the end of it. Now we're in what they call arrears for the preferred stock because we owed them 15,000, but only distributed 7,500. So if we look over here, of the 15,000 owed in year two, only 7,500 was distributed. So the remaining 7,500 that we owe is now added to the 15,000 that we owe for year three. And that's where this 22,500 number came from. So in year three, we now owe the 7,500 from this year that we didn't pay out, plus the 15,000 for this year. And if we look here on our problem, we distributed 45,000. So I took the 45,000 that we distributed, 22,500 went to preferred because that's the 7,500 plus the 15,000. And then if you do the math, that means there was another 22,500 remaining that we were able to pay out in common dividends. So once you know how much was actually distributed per preferred and common, now we can go down here and talk about the dividends per share, which is what the problem's actually asking you. It's asking you to determine the dividends per share for the preferred and the common stock. So we had to do this problem first to determine how much it went to preferred and how much went to common. So now we can go down here and determine the dividends per share. So the dividends per share is calculated by taking the number of dividends distributed and divided by how many shares the company has. So in year one, 15,000 was preferred and 7,500 of the 22,000 distributed, 15,000 went to preferred and 7,500 went to common. So if you come down here in year one, we'll calculate our dividends per share. We take the 15,000 and divide it by 30,000, and that gives us a 50-cent dividend per share. We do the same for the common. We'll take the 7,500 distributed, divided it by the 50,000 shares, and we get a 15-cent dividend per share. So we'll just come over here and plug that in. And if you look over here, I went ahead and did it for year 2 and year 3 as well. And it's the same formula. It's whatever is distributed divided by the total number of shares. So we'll just go ahead and plug these numbers in. Now, if you notice in year 2, we did not distribute any common stock dividends because it all went to preferred. So in that situation, you would just enter a 0. And in year 3, 75 cents dividends per share for the preferred, and it was 45 cents dividends per share for the common. And again, it's just taking what was distributed divided by the total number of shares, and you get your dividends per share. So let's go ahead and check our work, make sure everything looks good. So again, it says here to keep in mind that the question is asking for a dividend per share for each year and class of stock rather than the total amount to be distributed. But we had to determine the total amount distributed before we could calculate this. All right, here we're going to talk about how to do some entries for issuing stock. So the first, we'll read the problem. On May 23rd, Stoltz Realty Inc. issued for cash 108,000 shares. Basically, that means they sold shares for cash. They sold 108,000 shares for cash and they sold a no par common stock at $9. Now, it does give us information that this common stock has a stated value of $5. So we know that we're going to have some paid in excess that we're going to have to record. Then again, it said on July 6th, Stoltz Realty Inc. issued at par value 43,000 shares of preferred stock at a $10 par. And then on September 15th, Stoltz Realty Inc. issued for cash 15,000 shares of preferred. That's a $10 par at $12. So again, we're going to have excess paid in capital excess again. So first thing we want to do is do some simple math to figure out the dollar value of these shares that were issued. So if you look over here on my little cheat sheet over here that shows some notes, it tells you that the dollar value, you can basically just take 108,000 shares and multiply it by the $9 that it was issued at, and it's going to tell you that it was $972,000. Now we know we had excess, so we're going to go ahead and determine what was the value of the common stock that was issued. So then we'll take the 108,000 shares and multiply it by the stated value, which is $5 a share. And that came up with 540,000. Now we have to determine what was the paid in capital and access of the stated value common stock. And you could do it one of two ways. You could take the 108,000 shares and multiply it by the difference, or you can just simply take 972,000 minus 540,000, and that'll give you your difference. Both math works out just fine. But once you figure that out, your calculations out, you're going to come down here to your ledger and you're going to do your journal entries. So the first thing we're going to do here is, because we issued stock for cash, we're increasing our cash. Cash is increased with a debit. So your debit entry is going to be to cash for the $972,000. Now we need to record the common stock that was issued, and we record it at the stated value. So your next entry is going to be to your common stock account. And that's going to be a credit of $540,000. And then lastly, because we did issue the stock at a higher value than what was the stated value, we now have to do a entry to our paid in capital and access, and it's an access of stated value common stock. And that's where we're going to record the $432,000. So we'll move on to the next problem. It says on July 6th, Schultz Realty issued at par value 43,000 shares of preferred stock at a $10 par for cash. And that's just basically taking the 43,000 shares issued multiplied by the $10 par, which is 430,000. And then, so down here, again, we're going to increase our cash, and our cash is a debit for 430,000. And then we have to record the preferred stock that was issued. And so here we record that as a credit to the preferred stock account. Now on September 15th, we issued more preferred stock. We issued 15,000 shares of the stock, but this time we issued the stock at $12, still valued at 10, but we issued it at $12. So again, you're going to take the 15,000 shares, multiply it by the amount it was issued, which is $12, and that's $180,000. There's your cash entry of $180,000. Now the common stock, that's a typo, that should say preferred stock. I apologize. The preferred stock that was issued at 15 was a value of $10 a share. So we're going to come down here. I'm going to put preferred stock at 150,000 because that was the value of the stock that we issued. And that's what we're going to record it as. I'm going to typo there and fix that real quick. Now, because we issued a stock at a higher value than what is the stated value of it, we're going to have a paid in capital in excess of par for preferred stock. And again, you can do the math two different ways. You can take the 1,500 shares and multiply it by the difference to get the 30,000, or you can just take the difference between 180 and 150. Either way, you're going to do an entry to the paid in capital in excess of par preferred stock. And you're going to do a credit entry in the amount of $30,000. So if you come down here, and that's exactly what the entries are. All right, now in this problem, we are going to be looking at entries for issuing stock. So this is going to be very similar to the problem that we just did. So I'm just going to run through this really quickly. So if you look over here, I've got my little calculations again, to where you're basically taking the total number of shares and multiplying it by the issue amount. So in the first one, we increase our cash for the total sale price. And then we record the common stock. So again, on January 22nd, Limerick Corporation issued cash for 16,000 shares of no par common stock at $30. So this is a really simple entry. You take the 16,000 shares and multiply it by $30, and that gives you a total of $480. So it's just a real simple. You just increase your cash by the 480,000, and you record the common stock issued at the value, which is 480,000. All right. So then now let's look at February 14th. They issued at par 4,000 shares of 7% $100 par preferred stock for cash. So you're basically going to come over here and you're going to take 4,000 shares and multiply it by $100, which is your $400,000. And again, your journal entries is to cash because you're increasing your cash. You issued stock for cash. And this time it was preferred stock. Now let's look at the last one. On August 30th, Limerick Corporation issued for cash 22,000 shares of preferred stock that had a $100 par, but they issued it for 108. So that tells us right there they issued it for more than the par value. So we're going to have a paid in excess. So the first things first is, again, you're going to take the 22,000 shares that was issued at the amount it was issued for, which is $108. And that gives us a grand total of $2,376,000. And that's how much we're going to increase our cash by. So the next thing you're going to do is you now need to record the preferred stock issued, and you always record it at the value that it was issued. I don't have enough zeros here. Let's fix that. Okay. So with that said, you take the 22,000 shares and you multiply it by the value of the stock, which was $100 par. So we're going to record our preferred stock that was issued at the value of the stock, which is going to be $2,200,000. So since we received more cash than what the stock is valued at, that means that we now have a paid in capital in excess of par. and that's for preferred stock. So we're going to go ahead and select that account that we're going to record it to. And the calculation, again, can be done multiple ways. You can simply do a subtraction, taking 2,376,000 and subtract 2,200,000, or you could take the 22,000 shares and multiply it by the difference of the issued rate and the par rate. Either way, that a calculation should come up with you have a paid in capital in excess of par of 176,000. So go ahead and check our work. So it says here to remember that a separate account is used for recording the amount of each class of stock issued to investors in a corporation. And that the definition of legal capital and how it applies to how the sale of the stock is recorded. So that's very important. That's why we always do a separate entry for common stock and a separate entry for preferred stock. Okay, so the next problem I want to talk about are entries for stock dividends. So a stock dividend is a distribution of shares of stock to stockholders. So stock dividends are normally declared only on common stock, and they're issued to the common stockholders. So in this exercise, the board of directors declared a 3% stock dividend to its stockholders when the market price was $49 a share. So first, we're going to calculate the amount of the dividend by multiplying 271,000 shares by the 3% stock dividend. And we compute the stock dividend declaring during the year was, if you look here, calculations, the dividend declared is 8,130 shares. So now, to be able to record these shares, we need to multiply it by the market value, which gives us a value of 398,370. All right, so once we've got that calculation done, next we credit stock dividends distributed for distributable by multiplying the 831 shares by the $30 value, which we did here. Now, just one moment. So what we're basically doing here is, up here, we multiplied it to determine the market price of the stock dividend. Here, we're doing it to get the par value of the shares that were distributable. And so next, what we'll do is we're going to calculate the excess of par amount. We basically multiply the number of shares by the difference between the par value and the market value of the stock. So basically, if you take the difference of $49 less 30, is basically going to give you a value of $19. So then you're going to take that $19 and multiply it by the total number of shares distributable, which was going to come out to be 154,470. So with that calculation done, let's go down here and let's look at our journal entries. Ignore this table right here. And let's focus on the table over here. So the first calculation we did up here, we were able to determine the total stock dividend and the value of the stock dividend based on the market price, which was $49 a share. So we multiplied that by the total number of shares distributable, which is 8,130 shares. So we're going to record that. That's going to be our debit entry. Now, stock dividends distributable, we have to now record we have to record them at the par value. And the par value was $30 a share. So we come over here, we multiply total number of distributable shares, which was 8,130 shares, by the par value, which is $30. And that gives us the par value of the stock dividends that are distributable. And since we did it at the market price, which was $19 more than the par value, we now have to record the paid in capital in excess of par common stock at the difference, which was 154,470. Now, on November 30th, if we look up here, they declared that the stock to be issued to the stockholders. So when we do that, we have a journal entry showing the stock being issued. So we basically take it out of the stock dividends distributable and record it against the common stock account. Okay, so the next one we're going to look at are entries for treasury stock. Now, treasury stock is stock that a corporation is issued and then reacquired using the cost method. Treasury stock is debited and then and cash is credited for the cost or purchase price of the stock. So when the stock is then resold, cash is debited and treasury stock is credited for its cost. And then paid in capital is debited or credited for any difference between the cost and the selling price. So if we look here on January 31st, Wilderness Resorts acquired 21,000 shares of its common stock at a $31 per share. So this is what the entry will look like for January 31st transaction. So the first thing you do is you're going to determine what the treasury stock value is, and that's going to be 21. You're going to take the total number of shares, 21,900 times the $31 per share price. And so then what we do here is we're buying back the stock. So then we're going to record it as a debit to our treasury stock and decreasing our cash. Now, so the next thing we're going to look at is for April 20th. On April 20th, Wilderness Results sold 11,300 of the treasury stock at $41. So the entry is going to be a debit to cash for the selling price of the stock, which is 463,300. And then treasury stock is then credited for the original purchase price of the stock, which was what, $31. So the first thing we do is we take the 11,300 that was sold, multiply it by the sell price of $41, and that's a total of 463,300. So we're going to go ahead and increase our cash by that amount with a debit. Now we've sold the treasury stock, so now we're going to do a credit to our treasury stock account, but the dollar value that we recorded at is the value of what we purchased it at. So we purchased it at $31 a share. So we take that $31 and multiply it by 11,300. And so we record the treasury stock that was sold at its value, which is 350,300. That is going to give us a paid in capital excess from the sale of the treasury stock. And so you can, again, this math is the same. I personally just take a difference between the sell price and the purchase value price. And then that tells me what the paid in capital is going to be. And that's going to, again, be a credit. All right, so lastly, on October 4th, Wilderness Resorts sold the remaining shares at $27 per share. So a sale of the treasury stock could result in a decrease to paid in capital if the price to resell the shares is less than the original cost of the shares purchased. So on October 4th, the corporation sold the remaining 10,600 shares of treasury stock for $27 per share. And so the entry is a debit to cash for the selling price of the stock at 286,200. So again, let's look at this. We saw, again, sold it. We sold the remaining shares, which was 10,600, and we sold it at $27 a share. So then we were going to go ahead and debit our cash for that amount of $286,200. Again, the value of the stock that we sold was how much we purchased it for. We did that up here in this part of the problem, was just $31 a share. So you take the remaining 10,600 and multiply it by the purchase price, which was $31. And that's going to be our credit entry to treasury stock. And that comes out to 328,600. Now, quickly, we're going to look at this. Our cash is, in this situation, is actually less than what the value. So what we sold it for was actually less than what it was valued at. So when you have that situation, then you have a debit entry to your paid in capital for the sale of treasury stock. Because in this situation, we actually sold the stock for less than what we purchased it for. So we come down here, that's going to be our journal entries, which is basically what I have outlined right here. Okay, the last problem I'm going to go over in this video, and again, I'm really just hitting on the problems in your homework that involve a lot of math. This one, I don't think is all that difficult. It's an earnings per share calculation. And so if you look over here on the side of the screen, it shows I give you the formula for calculating your earnings per share. And so you basically are going to take your net income less your preferred dividends and divide it by the average number of common shares outstanding. So in this problem, it actually gives you all that information. You don't have to come up with an average yourself. It tells you what your average is for each year. So it's just a matter of plugging the numbers in and doing the math. So you're going to take the 590,000 minus the 90,000 of preferred dividends, and then divide that by 40,000 shares of outstanding common stock. And that comes up with a $12.50 per share for year 3. Once we plug in the numbers for year 2, we're going to take the 475,500 minus the 90,000, and then divide that by the outstanding shares of 30,000. And we should get about $12.85. So per share. Double check that math. Yes, so that's going to be $12.85. Now in B, it asks, does the change in the earnings per share from year 2 to year 3 indicate a favorable or an unfavorable trend? So let's look at this really quickly. In year 2, our earnings per share was about $12.85. And then it dropped in year 3 to $12.50. So a decrease in your earnings per share is definitely going to result in an unfavorable change. So let's just go down here and check our work. There we go. So I will probably post a copy of my notes here on the side along with the video so that you can hopefully watch along, use the handout along with the video to see if that is helpful or useful. Again, if you have any questions about any more of the homework problems, please let me know.